Gold isn't creeping higher. It's forcing the market to reprice what safe even means. And it's happening faster than most people can hedge because there is a quiet force trying to frame this as just fear, while the actual driver is mechanical, visible, and sitting right under the hood. And if you catch it early, you don't just understand the move, you understand what comes next this week, which level matters, and what breaks the setup if the wrong number prints. That's the payoff. So stay with me, because the most important signal for gold right now isn't even gold. It's the way the rate path snaps into place the moment the Fed speaks, and the market either believes it or rebels. And that's where the real pressure starts. The open matters this week because the first 2 hours are basically a truth serum. Either you're re-seeing real money stepping in with intent, or you're watching thin liquidity make price look stronger than it really is. Metals are notorious for revealing their hand when liquidity is patchy, because they're not just traded by views. They're traded by mandates, hedges, and collateral math. When the market opens after a weekend, a lot of orders that were patiently waiting suddenly hit at once. Asian flows, European positioning, and then the US session, where the derivatives complex actually dictates the tone. If you've ever watched gold gap hesitate, then suddenly rip or fade, that's not random. It's the market testing, in real time, whether there's a buyer underneath or just air. And this week, there's a reason the test is extra violent. The calendar is stacked like a loaded spring, Fed week, month-end positioning, and options timing compressing into the same narrow hallway. The market doesn't like narrow hallways. It panics. It overreacts. It forces people to do things they don't want to do. And that's when price discovery stops being opinions and starts being obligations. But that's not the part that matters. The part that matters is what has already changed about behavior before the next headline even hits. Gold isn't just up. Gold has crossed into that zone where risk desks stop arguing and start managing. In January alone, the price action has been so aggressive that a move from the low to mid $4,300 earlier in the month toward the high 4,700s and beyond isn't a cute chart anymore. It's a stress test for anyone short volatility, anyone short convexity, and anyone relying on normal correlations. And when a market does that, it changes the ecosystem around it. Liquidity thins because dealers widen. Volatility gets bid because protection suddenly makes sense. Spreads start to talk because carry traders get nervous. And positioning becomes the story, even when the headlines try to pretend it's just sentiment. Here's a tell that matters. In the gold futures market, open interest has been rising even as price pushes higher. And recently it jumped sharply in a single session, on the order of tens of thousands of contracts. That's not some trivia stat. That's leverage entering the building. And leverage always has rules. Leverage needs margin. Leverage needs liquidity. Leverage needs exits. So when the move keeps going, you don't just get buyers, you get forced buyers. But there's a flip side too, and we'll get to that, because this is exactly where viewers get emotionally baited into the worst possible timing. The next detail is what flips the whole setup. The one data point that can flip expectations fast is the market's implied policy path the moment the Fed meeting hits, not in a soft, philosophical way, but in the hard, mechanical way you see in the front end of the curve. Think the 2-year yield, think Fed funds futures, think the price of money snapping to a new probability map. The Fed meeting this week sits right in the bullseye, and the market is not treating it like a routine stop. The baseline expectation may be no change, but no change is not the same thing as no surprise. The surprise is in the tone, in the reaction function, and whether the Fed sounds confident that inflation is boxed in, or whether it sounds like it's still fighting shadows. The surprise is in whether financial conditions get acknowledged as tight enough, or whether the Fed basically invites the market to do the easing for them. And that's why the one number you should care about isn't just the statement, it's what the front end does immediately afterward. Because if that one number moves the wrong way, the math changes. Here's the hidden detail most people miss. Gold's move right now is not just macro, it's microstructure. It's the derivatives plumbing doing more price discovery than the headlines. That's not conspiracy. That's incentives and hedging. When options positioning gets lopsided, when there's a heavy concentration of calls sitting above spot, when open interest stacks around round numbers, dealers don't get to have a view, they have to hedge. And when they hedge, they can turn a grind into a sprint. This is where words like delta and gamma stop being geek vocabulary and start being the engine. Let me make it painfully simple. When a dealer sells you a call, the dealer is short that upside exposure. If price rises, that call becomes more sensitive to price. To stay neutral, the dealer buys some of the underlying exposure, futures, forwards, whatever hedges the book. That's delta hedging. Now, the important part. Gamma is how quickly that delta changes as price moves. In certain zones, especially near big strikes, delta can change fast. That forces the dealer to chase more hedges as price rises. That means the market can become reflexive. Price goes up, hedging buys push price up, which forces more hedging buys. It's not guaranteed, it's not magic, but when it shows up, it explains why moves feel like they won't die. And if you're watching gold at the open this week, you're watching for exactly that signature. Does the market dip and get absorbed, or does it dip and nobody shows up? Because those two tapes are different universes, and that's where the real pressure starts. Now zoom in on the calendar trigger, because this week isn't just a week, it's a convergence. The Fed meets on January 27th, 28, and right around that window you also have key gold options expiries in the COMEX complex, contracts whose last trade dates fall right into the same week. That matters because expiration is not just a date, it's a repositioning event. Positions that were comfortable suddenly aren't. Dealers roll exposures, funds rebalance. People who were short calls decide whether to buy them back or risk a squeeze. People who were long calls decide whether to cash them in or roll them up. And in markets like gold, where the narrative is already emotionally charged, those mechanical flows can masquerade as news-driven moves. But they aren't. They're forced choices. And forced choices move markets. The market can't unsee a line once it breaks. And in this case, the line isn't just a chart line. It ends the line where paper positioning runs into the realities of carry, liquidity, and risk limits. But that's not the part that matters. The part that matters is how you verify the move without needing to marry a story. You verify it with proof stacking, multiple independent signals that point the same direction. Here's your proof stack, and I'm going to keep it grounded in mechanisms, not vibes. 1. Term structure behavior. Gold typically carries a cost, storage, financing, so futures often trade above spot in normal conditions, a gentle contango. When the front end tightens, or when nearby contracts behave unusually relative to deferred months, it tells you something about urgency, financing conditions, and the willingness to pay up for immediacy. You don't need to pretend it's always a physical shortage, but you do need to recognize stress when the curve stops behaving politely. 2. Open interest and volume behavior. Rising open interest alongside rising price suggests fresh participation, often leveraged, which increases convexity and the probability of violent continuation or violent reversals. 3. Options timing and strike gravity. When round numbers like $4,700, $4,800, and especially the psychological $5,000 get involved, the options market can create magnets and accelerants, pinning near strikes or chasing through them when hedging flips. 4. Cross-market comparisons. If silver is also acting like it's trying to break the ceiling, if gold is outperforming or underperforming real yields, if the dollar is doing one thing while gold does another, that divergence itself is information. 5. Institutional flow logic. Steady inflows into bullion-linked vehicles, allocation shifts, and the behavior of official sector demand can underpin moves even when speculators get shaken out. None of these alone is a holy grail. Together, they tell you whether the move has spine. And right now, gold's move has spine. But the next detail is what flips the whole setup. The conflict you are going to see all week is the tug of war between paper, signals, and physical reality, and you have to handle that carefully. It's easy to get cartoonish here, and that's not what we're doing. You don't need a villain, you need incentives. Futures markets exist for hedging and price discovery, but they also exist for financing trades and risk transfer. If physical demand tightens, it can show up as premiums in certain regions, as delivery behavior, as leasing rates and financing dynamics, and as persistent strength in nearby spreads. If physical demand is fine and it's all financial, it shows up as fast money, crowded options, and high volatility with quick mean reversion. The trick is to watch which one dominates at the open, because the open is when people with real urgency show their hand. If you see quick dips get instantly bought, that's absorption. If you see sharp rips immediately sold into, that's distribution. And if you see up only with no breath, that's often hedging-driven reflexivity, until it isn't. Because if this one level breaks, the math changes. Here's how the market tries to manipulate you emotionally, even when nobody is manipulating anything on purpose. Volatility is a weapon. It can make a correct thesis feel wrong. It can make you abandon a position at the exact moment it's about to work, or chase at the exact moment the probability flips against you. The classic playbook is simple. First, a headline hits and price gaps. Your brain screams, "I'm late." Then the market pulls back hard and fast. Your brain screams, "It was fake." Then the market reclaims the level and pushes higher again. Your brain screams, "I knew it." That cycle is not accidental. It's how liquidity is harvested. It's how weak hands get transferred into strong hands. And the only defense is a plan that separates trend signals from noise. Trend signal is what happens around key levels and how the market behaves on the retest. Noise is everything else. If you anchor your decisions to the emotional part, you will donate money to the market's mood swings. If you anchor to the mechanics, levels, invalidation, and the one data point this week, You start acting like a risk manager, not a headline consumer. And that's where the real pressure starts. Now let's talk about the two-scenario lens, because it's the simplest way to stay sane without pretending you can predict every tick. Scenario 1 is the controlled pullback and retest. Gold can pull back because traders take profit, because the dollar bounces, because yields pop, because the Fed disappoints. In this scenario, you watch whether prior breakout zones hold as support. Think the high $4,600 to $4,700 area as a critical psychological shelf in current conditions, with $4,800 acting like a ceiling-turned magnet. The signature of a healthy trend in scenario 1 is a pullback that feels scary intraday but stabilizes, then reclaims the broken level with improving tape, higher lows, absorption, and less panicked selling. Scenario 2 is the continuation squeeze, where the market doesn't give you the retest you want. That's the nasty one. That's where thin liquidity, dealer hedging, and crowded positioning turn small moves into gaps. In that scenario, $4,800 stops being a number and starts being a doorway, and $5,000 becomes the kind of round number that forces people to chase just to avoid career risk. But that's also the scenario where the reversal risk is highest, because squeeze moves create fragile structure. They feel powerful, but they're often held up by flow, not foundation. And if the flow pauses, it can drop fast. That's why credibility means saying this out loud. Price can whip around violently even if the thesis is correct. You can be right on direction and wrong on timing and still get wrecked. So the plan has to respect that. The next detail is what flips the whole setup. Remember the one data point? Here's how you use it in real time this week. You watch the rate path reaction immediately after the Fed, specifically what the front end does. If the 2-year yield drops and stays offered, if Fed funds futures price in a more aggressive easing path, that is fuel for gold because it changes real rate expectations and weakens the opportunity cost argument. If the 2-year yield spikes and stays bid, if the market removes cuts and reprices tighter conditions, that's headwind for gold, even if gold initially rallies on a knee-jerk. The key is and stays, because the first move is often a trap, the second move is often truth, and the third move is where people get forced. So what you're actually watching is whether policy credibility tightens or loosens in the market's mind, because gold is a referendum on that. And the open tells you whether that referendum is being voted by real money or just by thin liquidity. But that's not the part that matters. The part that matters is what participants are forced to do. If gold keeps pressing above $4,700 and through $4,800 with momentum, dealers who are short calls get pulled into hedging. Shorts into futures who thought they were fated at the highs face margin pressure as volatility rises. Some of them cover, not because they changed their mind, but because the broker changed the rules. Funds that are benchmarked to volatility targets may reduce risk when vol spikes, which can create sharp pullbacks even in bull trends. Meanwhile, systematic strategies that follow trends can add exposure on breakouts, but they also dump on drawdowns. That mixture is why you get air pockets. The market isn't one group. It's a crowd of different rules colliding. That collision is price. And this week, the collision is louder because the calendar compresses decision-making. Options expire. The Fed speaks, month-end rolls. And in a metals market already stretched, that's not a normal week. That's a stress test. The next detail is what flips the whole setup. Let's get more concrete on what to watch next, without pretending we have a crystal ball. First, watch the behavior around $4,700, not because it's magical, but because it has already been a psychological pivot, and markets remember pain. If gold opens above it and holds, that's strength. If it opens above and immediately loses it, that's a warning. Second, watch $4,800. If price gets rejected there repeatedly with heavy selling, it tells you supply is active, profit-taking hedging, or both. If price clears it and then uses it as support on a retest, that's a structural upgrade. Third, watch the approach to $5,000. If gold starts accelerating into it on rising volatility and thin liquidity, that's where the squeeze scenario gets real, and that's where your risk management matters most, because moves into big round numbers can become emotional and then snap back. Fourth, watch the curve and spreads around the Fed window. If the front end of the rate curve is screaming easier, it's hard to fight gold. If the curve screams tighter, gold can still rally on geopolitics, but it becomes a rougher ride. Fifth, watch the tape after the first sharp pullback. Does it get bought, or does it keep bleeding? That tells you whether this is flow-driven froth or an allocation shift with depth. And that's where the real pressure starts. Now, because your audience is not here for fairy tales, let's address the major counterpoints cleanly. 1. Gold at these levels can be vulnerable to violent mean reversion. If positioning is crowded and the dollar catches a bid, you can see sharp downdrafts. 2. If the Fed tone is more hawkish than the market expects, the front end can reprice higher. Real yields can firm and gold can get hit even if the longer-term story remains intact. 3. If risk assets wobble and there's a scramble for cash, even safe assets can be sold temporarily to meet margin calls. That's a real thing. People learn it the hard way. 4. Geopolitical headlines can create fast spikes and fast fades. Gold can front-run fear and then bleed when the fear doesn't escalate. 5. Liquidity itself can cause optical illusions. Then markets can print dramatic candles that don't represent broad conviction. None of those counterpoints remembered means the bull case is dead. It means the ride can be brutal. And if you don't respect that, the market will teach you respect. But that's not the part that matters. The part that matters is what invalidates the setup, because that's how you keep trust with yourself. Here's a clean invalidation framework for this week. If gold loses key support levels and cannot reclaim them on a retest, think sustained trading back below the mid to high $4,600 after failing to hold $4,700. And at the same time, the front end of the curve reprices tighter with the 2-year yield rising and staying up. The near-term thrust loses fuel. That doesn't mean gold collapses forever. It means the fast flip expectation gets delayed, and the market may need a deeper reset. On the other hand, if gold holds $4,700 on pullbacks, and the Fed-induced rate path reaction leans easier, or at least not tighter, then the market's default becomes buy dips, and the squeeze scenario stays alive. 2 scenarios, 2 sets of confirmations. One simple way to avoid emotional whiplash. Because volatility will try to make you do the opposite of what helps you. It will make you chase when probability is worst and freeze when probability is best. Your job is not to be fearless. Your job is to be structured. And that's where the real pressure starts. Now let's tie the hidden detail back to the open, because this is where you can actually see the mechanism in action without having access to anyone's book. Watch how price behaves around the first pullback after a strong open. If gold opens strong, pushes higher, then pulls back. The key is whether it pulls back in a controlled way with shallow retracements and quick bids, or whether it collapses through levels with no fight. Controlled pullbacks often signal hedging demand and underlying allocation. Sharp collapses often signal that the move was driven by thin liquidity or short-term positioning that can unwind fast. And when that unwind happens in a market with high open interest, it can turn into a margin spiral. Shorts cover into strength, longs puke into weakness, volatility spikes, and then the strongest hands buy when everyone else is exhausted. That's the cycle. And the market will try to trick you into thinking the cycle is news. It's not. It's plumbing. But the next detail is what flips the whole setup. What happens if gold surges and the mainstream says it's just fear? Here's the cleaner, finance-literate interpretation. Fear is the narrative wrapper. The driver is the repricing of the opportunity cost of holding gold and the repricing of policy credibility. Add in option hedging dynamics and you get acceleration. Add in month end and you get forced flows. Add in geopolitical uncertainty and you get persistent bids from people who want insurance. That's not one argument. That's a stack. Mechanism, flow, calendar, and behavior, all pointing in the same direction. And when you see that stack, you stop being surprised by the tape. You start anticipating the pressure points. So here's your near-term roadmap in plain language. Over the next week or two, the market is going to revolve around 3 things. The Fed-driven rate path reaction, the stability of gold above key psychological levels, and whether volatility turns into fuel or into fragility. If the market accepts higher gold and the front end stays soft, dips are likely to be bought and the squeeze risk remains. If the market rejects higher gold and the front end hardens, rallies are likely to be sold and the market may chop or reset. If liquidity gets thin and options hedging turns reflexive, you can get gaps, up or down. So you have to treat the tape with respect. And if you want a simple checklist, make it this. 1, does gold hold $4,700 on the retest? 2, does $4,800 flip from resistance to support? 3, what does the 2-year yield do after the Fed, first move, second move, and the move that sticks? 4, does volatility rise with price or does it rise against price? 5, do pullbacks get absorbed quickly or do they cascade? That's it. You don't need 1,000 indicators. You need the few that actually force behavior. Because if this one level breaks, the math changes. And one more thing, this is the part most people want to tell you because it's not sexy. If you're watching gold like a hawk, the market will try to weaponize your attention. Every spike will feel like urgency. Every dip will feel like doom. The only antidote is deciding ahead of time what you are willing to tolerate and what would actually change your mind. That's not caution. That's professionalism. And if you've been burned before, that's not a personal failure. Markets are designed to exploit human reflexes. The goal is to stop letting reflexes trade for you. Let structure trade for you. Watch the open, watch the curve, watch the levels, and watch how the market behaves when it thinks nobody is watching. Because that's when it tells the truth. And if you want to be part of a community that doesn't just chant narratives, but actually follows the plumbing, spreads, positioning, calendar pressure, and risk management, then you already know what to do. Keep your mind sharp, keep your plan tighter than your emotions, and remember, the market doesn't reward conviction, it rewards calibration.